Welcome to Turning Point's Clearway Capital Solutions podcast series, where we talk to leading investment managers and general partners in their respective asset classes about the evolution of their markets and how they're responding to these changes. Established in 2008, Clearway Capital Solutions is an independent and privately owned company providing business development and capital advisory services to investment managers in alternative and traditional asset classes who are seeking to engage with Australian and New Zealand investors and their consultants. The Turning Points podcast series provides listeners with direct access to the insights of our investment partners.
Today we are joined by Ben Deere, Chief Executive Officer and founder of Osmosis Investment Management. Osmosis Investment Management manages developed and emerging markets equity portfolios using a proprietary investment database, MORE, or Model of Resource Efficiency, to identify companies utilising objective, publicly disclosed data, which are generating greater economic value per resource input, energy consumption, water consumption and waste production, than their sector peers. Osmosis believes that forward-thinking companies that take a proactive approach to a more sustainable future deliver greater value to their shareholders. Osmosis manages core and active, systematic, quantitative strategies to generate repeatable alpha in resource-efficient global, emerging and regional-based equity portfolios. Dennis Mathonius, Managing Director at Clearway Capital, is speaking to Ben.
Hi Ben, thank you for joining us today on the Turning Points podcast. Could you provide some historical background on Osmosis Investment Management?
Yeah, thank you, Dennis. It's a pleasure to join you again for the second time. Aptly named podcast, I should say, Turning Points, because we are obviously in a turning point if ever there was one. My name is Ben Deere. I'm the CEO and founder of Osmosis Investment Management, a sustainably focused, long-only equity manager based out of London.
Please tell us briefly about yourself and your role at Osmosis Investment Management.
Yeah, I should start with the headline points. I'm 54 years old. I set up Osmosis over 18 years ago as the founder. So responsible for, the idea, the concept of trying to grow an asset management business initially that I thought would be good to develop products that I personally would want to invest in that targeted an environmental theme, but importantly targeted better risk-adjusted returns through the process of identifying companies using hard quantifiable data that were able to produce more whilst consuming less of the planet's planet's resources. 18 years later, just very quickly as a firm, we've obviously matured as a business. There's 38 people. We've managed close to $18 billion in assets under management. That's US dollars. And we predominantly manage investments on behalf of pension funds, insurance companies, family offices and endowments, not just out of the UK, but more broadly across the world. Obviously Australia, we have a very large book of business, North America, Asia, and obviously Europe and latterly the UK. We're majority owned by myself and my colleagues, which is great. But we also have long-term institutional shareholders who we've brought onto the capital structure since inception, actually, but more recently with a deal with Nikko Sumitomo to open up the Asian markets for us, who are very long-term and delighted to say, obviously, been an environmental investor, very patient shareholders as well.
Great. Ben, can you tell us a little about Osmosis' overriding investment philosophy in managing resource-efficient equity portfolios?
Yeah, sure. I'll try to keep this simple. One should always try to be able to articulate your investment thesis as simply and as clearly as possible. So we disaggregated when we launched the firm, the ESG, to focus purely on the E, the environment. We believed, and I do couch a lot of these interviews I give between obviously when we started, which was just based in belief, and what we're doing today now, which is obviously based upon historical evidence and fact. So 17 years ago, 18 years ago, we had a belief that you could invest with an environmental focus, of which there are multiple. So I'll dig a little bit deeper into what our focus is. But as a consequence of targeting an environmental benefit, so mitigating environmental risk in equity portfolios, whilst also targeting the opportunities that come from targeting environmental exposures, we believe you should be able to target a better and deliver a better risk-adjusted return than a respective benchmark. And really the fundamental driver behind that was we believed if you could identify better risk-adjusted returns and have an environmental benefit, there's kind of a double-headed win. And you should be able to transfer and scale capital reallocation in size to have a meaningful impact, eventually, one would hope, on the cost of capital of companies within our investment universe. Reward companies by going long or overweight, those companies who can create more value using less natural resource, and underweight or indeed short those companies who we deem as environmentally inefficient. So the premise being of resource efficiency is, looking at companies really importantly on a sector relative basis to compare using hard quantifiable data across three metrics. So we're not just a carbon house. We're very much more broadly diversified than that, where we believe the environment is not just a carbon issue. So we also look at water and waste. They act in aggregate. We would argue companies that manage their carbon or their energy consumption, the amount of waste that they're creating, and the amount of water they're consuming. We believe if you aggregate those three factors, denominate by revenue, and identify those best in class on a sector relative basis, those companies who are producing more, using less, will probably have pretty strong quality management teams. So the belief at the beginning was if we could identify this data, standardize it, and integrate it into traditional portfolio theory, that our alpha signal might be driven by a proxy for a new form of quality management yet to be priced by the market. It's quite simple. Find companies, do more, who are doing more by utilizing less, that's resource efficiency, and do they, as a consequence, return more cash to shareholders. And our initial evidence back in 2008-9, when we started on this journey, was very limited, actually. We were challenged by a lack of data in terms of historical time series, because the amount of companies producing this data, we only really had the quantum of data available from 2004, 2005. So we had a very limited back test. But within that limited back test from the modeling work that we did pick up a signal, an alpha signal, that proved out this very simple investment thesis that we have, that companies who produce more, consuming less, should have better operating margins, be able to weather both inflationary and, we hope, deflationary environments as a consequence of having more pricing power, and ultimately kind of reverse engineering. So rather than traditionally going, look for quality style businesses, when you looked at the businesses from a fundamental perspective, we could identify that we were picking up good quality signals, so typical quality approaches. So there was a quality bias to the portfolios coming through. So we model now, when we started, this is quite interesting, I guess, against the background that we see today, the macro background. When we started, we only had about 400 companies, I think, in the MSCI world who disclosed on their carbon, water, and waste. Today, we have in excess of, I think, of 850 companies just in the MSCI world. More recently, we've extended our reach into the emerging markets, which is absolutely critical, because as many of your listeners might know, what the developed markets have done for the past 40, 50 years is export their manufacturing to less rigorous environmental regimes and offshore their manufacturing, so on and so forth, while saying that they've managed to reduce their own carbon emissions, but exporting them predominantly abroad to developing or third world countries. So moving to emerging markets now gives us a much more holistic view of the world, and to be able to take a much more pragmatic view for investors to target regional exposures as well as sector exposures as well.
Ben, you kind of already touched on this, but Osmosis have always ascertained that it's important to draw on objective data and eschew third parties. Can you tell us about Osmosis's team of analysts dedicating to verifying and gathering environmental data? And additionally, what effect has AI had on the process?
Yeah, sure. So when we launched the firm, we looked, obviously, because we're systematic and quantitative in our approach, so clearly we're data-driven, and we wanted to, examine, explore, interrogate environmental data to see whether or not it was fit for purpose. And what we found back in 2008-9 was very similar, actually, in a slightly different way, but very similar to what we see today, which is that the availability of data from third-party data vendors was suboptimal for utilization and investment process, which would determine the allocation of risk based upon that data. And just going off topic a little bit, I think asset management should be, and historically have been, and we hope continue to do so, be accountable for the risks that they manage on behalf of their investors, be that institutional or retail. When we take that accountability very seriously. So what we didn't want to do is use suboptimal data to drive the allocation of risk. So we had to take a very expensive decision, one could say, which was rather than rely on any third-party data feeds, to go and collect, clean, and standardize this data ourselves. And there was no AI back in 2008. Not that we could use anyway. So it was a manual process, which meant we had to build a team. And finding a team obviously challenging because nobody was doing this. So people, you couldn't go reach out into larger organizations and identify people to headhunt away. So we built a team from scratch. We took a range of young-ish individuals, not necessarily from financial markets background. We didn't want to bring old school thinking into a new investment approach. So we wanted to kind of open this opportunity to fresh eyes and fresh thinking. So we built a team from scratch of people with science-based degrees who had a passion for the environment and who obviously clearly believed in our investment thesis, as again, I have to reiterate it was a belief, and that we would be able to prove this out. So the team now has obviously scaled as the amount of the quantum, the breadth of the data has increased over time, and obviously our regional exposure has spread into emerging markets. So the team now, in terms of numbers, I probably have to ask Lisa where we stand in terms of numbers. There's probably around a dedicated team of about 10 to 12 people who are solely dedicated just to doing this. So they're not spreading their time on other activities. Their day jobs are collecting data, cleaning data, standardizing data, understanding, importantly, the interaction of that data at a company level to the balance sheet, so the environmental balance sheet, how it interacts with the financial balance sheet, and as importantly, understanding and continuing to reach into external third-party data, which a lot of our investors use, to understand and spot where the flaws are in order to help guide, inform, educate investors where there might be a misallocation of risk occurring as a consequence of poor quality data. And that has two impacts if you're using bad data. You're misallocating risk, but unfortunately also when you come to do the environmental footprints, the environmental footprints don't really stand up. And we have so many, multiple evidences of suboptimal data driving poor risk allocation and therefore fictitious, we would argue, environmental footprints. So neither serving the opportunity to get better risk-adjusted returns or to mitigate environmental risk in your portfolios. So everything we do from the data research team, excuse me, is about the quality of the processes that we put around the collection, cleaning, standardizing, and then the integrating of that data into our portfolio construction.
You referred to water and waste previously. Carbon emissions has always been a key focus of investors over the last few years, but we're starting to see more regulations in water and waste. As you mentioned, Osmosis have always maintained that water and waste is equally important. Can you talk us through that rationale?
Yeah, sure. I mean, I guess everything starts with an idea. So nothing particularly sophisticated about the thought process around this. Excuse me. But when we started discussing what data signals we wanted to use, I mean, firstly, you need to identify data where there's both the quantum, the availability of that data in scale and size to be able to make relative observations between companies. So you needed you needed to be able to not just say, well, this is a good idea, but also be able to gather enough information to prove that idea out. And actually, sitting at home, no doubt as many, again, of your listeners may have found over the last 5, 10, 15, 20 years, your water bills have been going up exponentially, depending on where you live in the world. And try going to dispose of your waste at landfill. So your waste costs. And that's just on a personal level at home. So energy bills going up, water bills going up, waste bills going up. And you really just magnify that and scale it by, 1,000, 10,000 times, depending on the size of the company relative to your household. And we kind of just assume that corporates would be feeling the same kind of pressures. So was the data available to look at these other metrics? Would it provide a signal in its own right? So was it meaningful? We just didn't want to bring in noise into the portfolio. And if we could prove out that there was the quantum, that there was an independent signal from waste and water as well as carbon, and then importantly, if you aggregated the three together, the question we often get asked is, how do you weight those individual factors? Well, hindsight bias is a wonderful thing, and we know how to optimize that to give a wonderful backtest. But we have no really perceived view of the future pricing of these, either as an externality risk or as a physical cost to the balance sheet. So we just equally weighted each of those factors in the portfolio into one factor, which is our resource efficiency factor. And what we found as a consequence of that was a much more stable signal. So if you're just focusing on carbon, don't get me wrong, it's a great thing to be doing. Investors should be reducing their carbon exposure if they can, within relative risk budgets. But carbon, as an individual factor is incredibly volatile. As is water and waste, as you could imagine. There's lots of different drivers that can affect companies around the world, depending on their jurisdiction. The way the political wind is blowing, as we're seeing in North America at the moment, can have an impact. Things like carbon pricing can have an impact. Societal pressure can also have an impact. And of course, the weather. It also can have an impact. So, or maybe one should say the climate, but on a daily of this data available, we were surprised in the beginning to be able to identify as much data as we could, to be able to integrate it into a single factor. But once we had that, then we've obviously been collecting that now since inception. And companies disclosing this data, again, we kind of believed in the beginning that why would they be doing this? Not every company is a good corporate citizen, as we all know. But often, and as we see today, it's the dirtiest sectors and the dirtiest companies that often have the best disclosure. Now, are they just good corporate citizens wanting us, people like Osmosis, do as a favor to provide the data? To some extent, yes. Investor pressure obviously has helped that and made sure disclosure has become more meaningful to companies, not just in dirty sectors, but across the whole economy. But they do it because clearly, if you're measuring this data, any corporate that measures any form of data seeks to manage it. And if that data is related to a cost or a potential risk, then you seek to reduce it. So, again, just common sense. If companies are measuring it, they're managing it, and if it's a cost, then naturally they should be managing to reduce. And those that do that better, whilst also managing their financial balance sheet, so it's not just all in, we're just going to do this at any cost. There are companies clearly that do that. But they have to be growing their revenue. It can't be an absence of financial performance. And that's what our models ultimately detect. So a three-factor approach is very unique. We're not aware really of anyone else doing this, how we do it. It is possible to go to external third-party data and get obviously these individual factor scores now. But then you're going back into the discussions around the quality of that data, having no in-house expertise, to be able to ascertain whether or not that data is fit for purpose, and really, it's caveat emptor, as we say, buyer beware. So again, having that in-house process to give us the in-depth understanding and knowledge to be able to ensure that we have one of the cleanest and longest duration data sets around environmental data, we would argue probably in the world.
Engagement has always been a strong focus at Osmosis, and last year you launched a collaborative campaign with your clients to target some of the big corporates that are failing to disclose their data. Can you tell us about the campaign and what you're seeking to achieve?
Yeah, so engagement for me was a challenging conversation. As a boutique asset manager, and I'd argue obviously even with $18 billion, we are still a boutique. We're emerging from that kind of status, but we are a boutique. But engagement, it was always the premise of the firm that you couldn't engage really or have a loud voice, when you're running $500 million or $1 billion, your engagement letter would probably just get discarded and ignored, and you're a small voice in a large ocean, and you just have no impact, and it's expensive. It takes time to do this properly. So as a firm, despite pressure from mainly consultants and people that score you externally on your activities over the last 10 years, I guess, was you're not doing that, so we're going to score you down. You should be doing it. And it's like we need to focus on what we know, which is really building portfolios and integrating this environmental data in order that we can find the alpha, so we can scale to a size where engagement matters and you can have some impact. And you've got a client base that ideally you could kind of collegiately bring in together and utilize the weight of their assets in conjunction with yours to have real impact, because the scale effect comes into play. So I think it was beginning of last year, we broke through $15-16 billion of assets, which is reasonably meaningful, but we were running money for some very well-known, very significantly scaled pension funds around the world. And we know where there are holes within the data. And there's kind of a red list inside the firm of companies that should be doing better. They might be disclosing only one of the three factors, but we kind of would assume that they've got access to that data internally, and why they're not disclosing on, for example, their waste metrics. If they're disclosing carbon and they're disclosing water, why aren't they disclosing waste? We want it for our selfish purposes internally. Because it strengthens the signal statistically, the more data you have available. But are they hiding something, and as stewards of other people's capital, you want to know that answer, is there something this company does not want the wider investment audience or society just to generally know? So rather than just rushing in, which unfortunately a lot of engagement campaigns are, and there's been too many of them, and companies complain consistently that there's too many investors asking too many questions in too many different ways, and it just clogs up. Nothing happens, nothing changes. We refined our list, just to a few companies that we wanted to start the program with. We reached out to, a group of our clients and said, look, we believe, and the first target was Amazon. We believe that they should be disclosing on this data point, and they're not. Do you agree? Don't you? Would you join forces with us so we have more meaningful impact in the scope of that engagement? And maybe through this kind of aggregate approach, collegiate approach, with all our respective AUMs added together, our position sizes in the company, maybe they might respond, and maybe we might be able to have meaningful dialogue with them to understand why not. Why not, or B, obviously, hopefully to get them to put into the public domain this information, and maybe to some extent, and we've seen this before, to educate them on why we need it. We're using this as an investment signal. It's not just a nice to have; it's a need to have. And if you have it, it allows you to score you more effectively, and if you're doing a good job and it makes you more efficient relative to your peers through our models, then obviously you get a higher weighting and more capital is attracted to your company. So there are net benefits to this. So we launched the campaign several months ago. I think in excess of $750 billion of combined assets is now engaged on that campaign. We're trying to get it up to $1 trillion. That would be a nice number. And we are now getting inbound calls from asset owners saying, who we don't actually manage money for, saying that we've heard about this. Could we discuss potentially joining this joint collaboration engagement project with you? And that's, I mean, for me, you look at it and think, wow, that's a really a maturing of our business, you know, scaling the firm to an institutional class style business and actually having the confidence of our own investors and those now calling in to want to work with us, because one of the challenges of a small asset manager is, you know, is always, are you going to be here tomorrow? You know, reputational risks, signing bits of paper with clients, you know, together, and to kind of cross that boundary as well. Really, it kind of indicates to me that, you know, the meaningful impact we can have just scales. And I've always said this, the bigger we scale, the faster we scale, the more assets we run, the louder the voice we have, the more impact that we could potentially have as investors alongside our clients. And we're kind of seeing that now, which is a really exciting place for the firm to be.
You mentioned the backlash before. There seems to be a growing backlash against climate mitigation strategies, and seems to be accelerating under Trump's administration. What are your thoughts, and how might it impact Osmosis's business?
I could talk about this for hours, ideally after 5 pints down the pub, to be honest, to get it all out. But so is there a backlash on climate-styled investing? That's question number one. I would argue not. You know, we added, I don't know, $3 billion of assets last year. I mean, we're a small microcosm of the overall, you know, ecosphere of asset management. So, you know, with the exception that proves the rule, I don't know, to be honest. We are seeing, obviously, and witnessing outflows, but more generally, I would argue, seeing outflows around more broadly ESG themed funds and investment strategies. And we don't do ESG. Going back, you know, several years, when tech collapsed and oil went up to $120, $130, most climate strategies and ESG strategies hemorrhage performance. Multiple reasons for that, you know, mainly down to kind of portfolio construction and really a lack of consistency on the understanding of what it is to be sustainable. That portfolio construction ended up really with portfolios that were just, you know, long tech or long growth and short value. So long tech, short utilities, oil and gas, and so on and so forth. So at the end of that year, they were all negative. And that's the large majority of assets. You know, I'd say over 80% of assets run in ESG, maybe 90% were underwater, and some quite significantly. And that gave power to the arm, certainly in the US, of the right-wing movement to say that ESG is a scam, doesn't work, because look at the performance, it's so bad. And rather than the industry turning around and saying, oh, you know, we're kind of fessing up, it's not that it doesn't work, it's just that we're really bad at portfolio construction. We didn't really understand, you know, what sustainability meant. You know, for us, sustainability doesn't mean buying more Facebook, Apple, Netflix, and Google. I mean, it's ridiculous. No impact at all. Well, minimal impact, you know, on the environment. They're asset-light businesses, for one. So, you know, where are you going to get the most impact? It's going to be in utilities, the dirty sectors, not in the asset-light sectors. So that kind of underperformance gave fuel to the fire of a narrative. Certainly in the US, mainly in the US, actually, this doesn't work. It's a scam. And the pushback started there. You know, that was really, you know, sowing the seeds of chaos that one could argue that we're kind of entering into at the moment. And in the US, there is pushback, big pushback, to the extent that, you know, there are many firms, large firms, you know, multi-trillion-dollar asset managers, who find themselves in a bit of I think it's a dichotomy. So in the US, they are rolling back teams have been let go. We see that because we get their CVs, coming through. And regulators, at a state level, making inroads into legislating against the integration of ESG data into portfolio construction. So, if you suffer a loss as an investor, that leaves you very exposed as an asset manager to litigation. So what do you do? Well, you jumped on the train to begin with a lack of experience and knowledge, hence you develop suboptimal portfolios. And what do? You knee-jerk reaction and get the hell out, because you don't want to open yourselves up to litigation risk under the new Trump administration. That's in the US. What do you do in Europe as these big firms? Well, you go around telling all your European pension fund clients that no, we're still all in. So you're seeing this kind of bifurcation in moral responsibility. In the US we're doing this because this is what the audience wants to hear, and in Europe and the rest of the world we're doing this, and that makes no sense at all. It's morally ambiguous at best, and that for us as a firm is opportunity. So we say we're doubling down into this because politics is transitory, with 4-year terms, depending where you are, maybe 5 years. Rhetoric is high, emotions are up. Let's dig more coal. Let's make coal great again, I think I heard last week. And, it's nonsense. It's compounding the problem for the next administration to come in and address. And those companies or asset managers, my peers or competitors of great scale, who have drifted in the proverbial wind on their morality and knowledge on these issues, are moving backwards and into any vacuum, gets sucked in, we would argue, new opportunity. And we are being drawn into that vacuum and still seeing as a consequence, not just that, because obviously we have our own brand recognition now, but as big investors step back, it gives specialists the opportunity to flourish. So we're doubling down, scaling up the firm, seeing more flow come through the door as a consequence. And indeed, just over Christmas, we launched 2 ETFs into North America. We're very contrarian. But the narrative around what we do is not we're here to solve all society's woes in one portfolio by looking at 135 ESG factors. We're just focused on efficiency. And actually the narrative tying into North America for us, with the Department of Government Efficiency, the word's in there, isn't it? Efficiency. So where are they learning that efficiency is a good thing? Like them or don't like them, very Marmite style individuals in the administration. There is a pragmatism behind that efficiency narrative. So if you really believe government can do more with less and society will benefit, well, if that learning has come from somewhere, yes, I mean, it's common sense, but the learning has come from somewhere, which is from the private sector, so companies do more with less, generate more profit, pay more back to shareholders, take more dividends as owners. So what that narrative plays into what we do, which is where we're targeting environmental efficiency. It's efficiency, use less, create more. So we're hoping, and again, I'm kind of almost going back to that belief factor that I had back in 2007 and 8 when we launched the firm, that this factor would deliver. I'm kind of also believing that in North America that, not everyone voted for this administration. I think there's, 37 to 40% of applicable voters or something voted for the Republicans. So, it is a minority. But out of the conversations we're having, there's very much a pragmatism still there that, we can't just talk ourselves out of this problem. And certainly if we're going to compound it, it's only going to be worse. And therefore, from an investor's perspective, taking off the morality hat just from a, return targeting perspective, that alpha opportunity should potentially scale greater because companies will have less time to do more actions with, which will require more capital at probably a greater cost because a lot of the policies that the US are potentially seeking to bring in are also inflationary, which means this dive to zero interest rates that the administration is crying out for. And I think it's interest rate decision day today. We'll see whether or not the Fed holds the line or whether or not they are also bowing the knee. One would imagine that they are independent and they will use the data that's in front of them to make the decisions rather than a nasty tweet. And if we are seeing a higher for longer environment, then it's going to be a real challenge. And for investors, I mean, it's bad news for the environment, but contrary to that, it could be reasonably good news for investors. So, we wear these two hats at Osmosis where, sometimes bad news is like good news on one side. So I think we hit 425 parts per million of carbon dioxide in the atmosphere this week, which is way above expectations. And the scientists are saying that's fueled by, the forest fires around the world over the last 12 months. That's awful. I mean, that's really bad. And it's just kind of this doom loop. The more aggressive the climate becomes, the more you get the fires and kind of, you're into this unfortunate loop. But on the other side, that kind of other side is, okay, so that means we really do need to act. Corporates are going to have to prepare. They're going to have to make investments. The longer they delay them, the more it's going to cost them. And our models pick up those companies that are already addressing this. So they're kind of ahead of the curve because of relative observation at a sector level. So I would rather personally be positioning companies that are addressing this and doing it in a financially astute way, rather than burying my head in the sand and buying companies that really aren't taking any action or are going to use this new administration cover to reverse policies. So there's a very long-winded answer. As I said, 5 pints of beer down the pub, and I could talk about it for hours because there's multiple different aspects to this that can be discussed. But that's kind of a short form, early London morning, no pints conversation around the topic.
In our industry, there's been more focus on biodiversity of late. And of course, we had our first biodiversity COP in 2024. Is Osmosis looking at biodiversity?
Yeah, we are. We haven't implemented it. It is really important. Clearly it is. But again, one of the challenges of being in the asset management industry is not just to jump into trends quickly, because you end up regretting it. And we've seen a lot of biodiversity funds launch over the last few years. Actually, this isn't just a this year thing. The meaningfulness of the data, the quantum, again, I keep going back to that, is not really there. It's very subjective. It's very third-party driven, often not by actually the larger firms and more specialist firms. And you see a lack of correlation between, obviously, those potential data sources as well. So you've got to choose whose version of the truth you want to believe, and then you're tied to that version of truth forever, pretty much, because jumping ship and going to another version of the truth, you then need to explain to investors why you made the wrong decision in the first time. So rather than just jumping in head first and saying, oh, this is a great way to raise money quite quickly, and often they've got a mid-cap, small-cap focus to these funds as well, so there's not much capacity. So how much really are they investing behind it? Is it a short-term grab for $1 billion and let's hope it all works out and it sounds good and we can tick a few boxes? We took a step back again, really like we did when we launched the firm, which is this is really important. Let's do a study. Let's see if the data exists. Is it possible to integrate? We reached the decision that it wasn't. So instead of leaping in, we took one of our guys, very smart guy, and said, you should go off and do a PhD in this and we'll fund it. So I always forget whether or not he went to Oxford or Cambridge. I think it's Oxford. And he's into year 2 or coming up to year 3 now of that project. And his job is obviously to advance, his own knowledge and get his PhD, but to come back to the office afterwards and tell us how to do this and to do it well and properly and be at the forefront of a robust and defensible approach to integrating either biodiversity into existing portfolios or creating new portfolios to cater and absorb, not just 500 million, but significantly more capacity. And I caught up with him a couple of weeks ago, and he said, he said it's fascinating, it's amazing. We were absolutely right. I know all the reasons why we shouldn't be doing this. And I said, oh, that's so exciting. He said, yeah, I'm writing a paper about it. I said, and I said, but have you found the solution yet? And unfortunately, the answer was no. So rather again than just saying, okay, come back to the office, let's start building something, we have to wait, patiently wait while he does his research to find a credible solution. And if we can't find it, we won't do it. This is not gathering assets at any cost. It's trying to do this the right way and the best way for our investors in a way that we can be held accountable, defensible, defending our investment thesis, the strategy, the data, and be accountable for that risk that we're privileged to run this risk. That's how we feel. And we've got to be accountable for that as well. So, we're not there yet, but we hope to be maybe next year.
We've seen poor quality, momentum-driven markets in recent months, given Osmosis's natural bias to high-quality companies. Do these short-term, low-quality rallies focus Osmosis even more on risk control and challenging your research assumptions?
Yeah, of course. Yeah, it's not an optimal market environment for, where momentum is really the only factor that's delivering returns. And I read an interesting paper last night on this kind of passive active debate and the amount of passive assets that are driving this kind of market cap led exposure. And, and I know many of my peers who are kind of more fundamentally based active managers are kind of almost throwing in the towel. Just, you're seeing earnings reports come in with, great earnings, nice forecasts, and stocks falling 15, 20%. You've got utility companies that kind of have an AI link in the US. One's called Vistra. It's moving around like a meme coin. It's not normal market dynamics at play. And there's lots of things, again, we could talk about it for hours, liquidity in the markets, the market structure changing with passive relative to active. But so as much as we've always counseled investors that if you get, long beta style, you can argue whether or not it's junk or not. I guess that depends whether or not you believe in AI, and if companies like Apple on record PEs are going up 3-4% a day, if that's normal, if that's the future. And that does challenge us, obviously, to relook. And we don't change our risk exposures because we are a long-term investment strategy within very tight risk frameworks. But the quant team are obviously always trying to identify, what are the market environments where it's worked better, which sectors is it working in, which regions, what's driving that, in order to enhance the models. But enhancing models is not something you do overnight. We're not active managers where, we can make a decision on Friday and come in and execute it on Monday. Any advancement to our models can take years. The last big adjustment we did was taking 3-factor. We needed to have companies disclosing on all 3 factors, and we did I think an 18-month study on 2 factors. Was there a signal in that? We identified that there was, but it shouldn't be scaled as strongly with the risk, according to a 2-factor company. I think that was 2 years from start to finish, and bringing all the clients in to make an adjustment to the model. So while we see what we're going on in the markets today, is it a cause for concern? No, not at all, because the long-term trend is clear. Clear. If rhetoric means that climate change goes away, and we just want to pollute for in scale, maximize profits, deregulate everything, the pendulum will swing the other way. It's really like politics in itself. Yes, you get a government that comes in and it goes too far to the right. The next thing you get is a government that's far too far to the left. Where we are in the UK at the moment. We've gone from kind of the Tory party who are, leaning into the extremes of the right to try and capture kind of that further right, far right vote. And then we end up with a Labour government who had to lean slightly more left. And now it's balancing a little bit as they're worried about growth, trying to be more centralist in their approach. And investment styles swing in a similar way. It's on you can't predetermine the timeline, ask any value investor that, or any kind of conservative low vol style investor. Factors come in and out of fashion as the macro changes. The one thing we are confident of, though, unfortunately, I have to say, is that the climate is not transitory. The political and the macro is. And if we were to try and second guess, what the markets were going to do tomorrow or next week or next month, we'd be crazy. We're not market timing. You could almost argue that we're almost trend following. The trend is clear that the climate is deteriorating. There will be more environmental risk within portfolios. And where do you want to position your wealth, your clients' wealth, for the future and for the longer term? I would argue it's in a risk-controlled, environmentally aware investment strategy that will do well as pressure comes back into markets because of that kind of natural quality bias that we have, but also protecting you against, these not even black swan events, but against, these environmental catastrophes, as we've just seen in, LA and Valencia. I mean, you could go on a long list. Those are the two that made the headlines, but all over the world. Insurers are going to be feeling that. Banks will be feeling that. And that will start eventually to be getting priced into the market. But it's not an overnight reaction. Markets, have their own momentum at the moment. I see today that the DAX has just hit another record high. Markets are not responding to what people are feeling. But there is a kind of one other aspect that, is that governments around the world, and I'm pretty much sure it's the same in Australia as it is over here in the UK and across Europe, and in the US, is the one thing they have in common is they've got no money. There's no money for social services. We're cutting back on everything. Meanwhile, all their stock markets are trading at record highs. Earnings are coming in pretty strong. Profit margins are widening, and somebody at some point will connect those dots and maybe decide, well, where's all the money gone? Banks are up, 40, 50, 60% on a 1-year basis. Well, there's a bit of a signal there. Corporate earnings are as I said, are pretty strong. We're in earnings season at the moment. So the corporates are making record profits. Society has no money. What's the next thing? Well, it's taxation possibly coming to corporates. Where do you want to be positioning your portfolio outside of the environmental aspects? Well, you want companies with better margins, operating margins. What's one of the things that leads companies to have better operating margins? According to our models, those companies that, have adjusted their operating models to mitigate environmental risk. So they're consuming less energy, water, and waste, because that's a proxy for lots of other things going on inside a company. And again, going back to that quality management argument, our signals don't just pick up these, but they lend themselves to identifying other things that a company is doing that we're not targeting. Because if you're managing, measuring, and reducing your environmental balance sheet as a corporate leader, you're probably managing your financial balance sheet and other aspects of the business just as well, if not better.
Ben, thanks for joining us on Turning Points. Is there any sort of parting thoughts you might have?
Well, we're coming to Australia again at the end of February, so I'm deeply hoping it's not a climate change event that we arrive into. One of the times I'm flying into Australia, I was taking photos out the window of smoke. I remember standing, I'd never been, I think I've been once or twice before, and I was taking a picture of my colleague Robbie in Sydney, I think it was maybe Sydney or Melbourne, to see how far away it was before he disappeared through the lens, through the cloud of smoke. So firstly, we're truly hoping that we arrive and it's just nice, lovely weather. And secondly, we would just ask investors. I guess investors are smart. They're long-term, and they need to separate their long-term investment philosophy from that of the political rhetoric. And that's what we're hearing and seeing. Corporates have been pretty poor in the US so far responding to Trump. Last time he announced he was leaving Paris, there were multiple state-level responses saying we're here, we're going to keep to Paris. There have been some still, which is great to see. But in the corporate world, it's been reasonably silent as they're deciding how to navigate this challenging period. But some of the conversations I'm having with corporate leaders in America are that they think this is kind of insane, that it will probably backfire, and that investors, when momentum starts to build against this, because they know it's the right thing to do, not just for the environment, but economically as well, it's going to be investors, asset owners, and society who kind of take that stand and of common sense. You don't need to go on the streets and protest and throw paint over, Dutch paintings in museums and things. But, you can vote with your money and vote with it long term. That's all we ask.
Thanks, mate.
Thank you very much. It's been a pleasure.